Okay, let's dive into this. In the world of finance, everyone's always talking about profit, profit, profit. But what if I told you there's another number, a number that tells a much truer, more honest story about a company's real health? Well, that's exactly what we're going to break down today.
So, I want to kick things off with a question that sounds, well, a little crazy. Can a company that's reporting huge profits literally go bankrupt? It seems impossible, right? But the answer is a resounding yes. And understanding why is what separates the average investor from a truly great analyst.
And here's the reason why. It all boils down to this fundamental difference. Profit, or net income, is really just an accounting opinion. It's based on a whole bunch of rules and estimates. But cash? Oh, cash is a hard, cold financial fact. It's the actual money in the bank that you can use to pay your people and keep the lights on. So, let's peel back that layer of opinion and get right to the reality of the cash. The tool we're going to use for this is called the Operating Cash Flow Ratio, or OCFR. Now, forget the complicated textbook definition. All this thing does is measure if a company can pay its upcoming bills using only the cash it made from its main business, not from some one-time sale or a new bank loan.
At the end of the day, it's really asking one simple but absolutely vital question. Is this business's engine powerful enough to run on its own, or does it constantly need a jumpstart from outside sources just to stay alive?
And the formula itself? It's actually dead simple. The number on top, the numerator, is the operating cash flow. That's the real cash that came in the door from doing what the company does every day. The number on the bottom, the denominator, is current liabilities, which is just a fancy way of saying all the bills they have to pay in the next 12 months. So let's put some numbers on this to see how it works. Say a company generated $250,000 in cash from its operations, and it has $120,000 in bills coming due. You just divide one by the other, and you get a ratio of 2.08. So, what does that actually tell us? All right, so we've got our number, 2.08. Now let's put on our analyst hat. What's the very first thing we do with this number? This is the most important check. It all comes down to this one single number, 1.0. Think of it as the ultimate dividing line. It's the bright line that separates a company that's financially healthy from one that could be in some serious trouble. Let's just visualize this for a second. Our example company at 2.08, it's way up here, comfortably above that 1.0 line. That's a healthy sign. It means for every dollar it owes, it's generating over $2 in cash. But look at this other company, down at 0.75. That's a huge red flag. It's only generating 75 cents for every dollar of bills it has to pay. Not good. So, what this reveals is crystal clear. A ratio over 1.0 means the company is operationally self-sufficient. It's a sign of real strength. But a ratio below 1.0, that signals potential stress. That company has to find money somewhere else, maybe burn through its savings, sell off equipment, or take on more debt just to stay afloat. But here's where things get really interesting. We have to talk about what this ratio doesn't tell you. Because, like any tool, it has a blind spot. And for an analyst who isn't careful, this can be a serious trap. Honestly, understanding this is what separates the pros from the amateurs. The source material is very direct about this. It says the single biggest weakness, the biggest limitation of this ratio, is that it completely leaves out something called capital expenditures. So what the heck is CapEx? Well, think of it this way. It's the cash a company absolutely has to spend just to stay in business. It's for maintaining its factories, updating its computers, replacing worn-out trucks. It's not optional. It is a mandatory cost of doing business, and the OCFR just pretends it doesn't exist. So to get the real complete picture, we have to take one more simple step. You start with that operating cash flow, and then you subtract that mandatory CapEx spending. Whatever's left over, that's the good stuff. That's called free cash flow. And that is the truly flexible cash a company has to grow the business or reward its shareholders. So now we've got the ratio, and we understand its big blind spot. Let's put all these pieces together and see how it fits into a professional analyst's toolkit. This slide is great because it really nails the key difference. Other ratios, like the current and quick ratios, are like a photograph. They show you a company's financial position at a single moment in time. But the OCFR, it's more like a video. It shows you the company's performance over a period of time, how cash is actually flowing. And this is why you have to look at them together. This is so important.
You could see a company with a great current ratio, looks like it has tons of assets. But if its OCFR is low, that's a massive red flag. It's what we call a liquidity mismatch. Yeah, they own a lot of stuff, but they're terrible at turning that stuff into the cash they need to survive.
So here's the game plan. A simple 4-step workflow. First, you calculate the OCFR. Easy. Second, you check it against that all-important 1.0 line. Third, you see how it stacks up against its competitors. And fourth, and this is crucial, you validate everything by checking its free cash flow to account for that CapEx blind spot.
All right, let's bring it all home. After everything we've talked about, what's the final verdict here? What's the one big thing to remember?
I think this quote just says it all. Net income, profit, it's like a promise of money. It's an IOU. But operating cash flow, that's the real deal. That's the actual cash in your hand right now. And so that really leaves us with one last question for you to think about. The next time you're looking at a company, ask yourself, are you just looking at the accounting opinion? Or are you willing to dig a little deeper to find the financial fact? Because honestly, that's what makes all the difference.